Hi, welcome to this my fourth data update for 2025. In my first three updates, I focused on equity markets. First looking at the aggregate US equity market in update 2, and then slicing and dicing that into market cap and price to book and sectors in update 3. In this one, I want to focus on interest rates. But my interest in interest rates lies primarily from an equity investor perspective. How does it affect valuations? And that is going to be my focus. Along the way, there is almost no way you can avoid the discussion of what role the Federal Reserve or central banks play in setting interest rates. So let's go back to the start of 2024. At the start of 2024, the consensus wisdom was that rates were going to come down. I remember listening in to CNBC, which I don't do often, at the start of 2024, and there was a group of Fed watchers and bond market predictors, and they all contended that rates would come down. And their primary rationale for doing so was that the Fed was going to cut rates. We'll come back and look at that argument, because the Fed did keep its side of the bargain. It did cut rates 3 times during the course of 2024. The rate it cuts, of course, is the Fed funds rate. Once in September, once in November, and once in December. But you know what? Over the course of the year, in spite of the Fed cutting rates, market interest rates rose. But market interest rates, I'm talking about treasury rates, corporate bond rates. So in this session, I want to focus on interest rates, both in the treasury market as well as in the corporate bond market, and look at the message that we're getting from those markets about risk-taking and risk aversion. So let's start by looking at U.S. treasuries in 2024. In this graph, I've looked at U.S. treasuries across the spectrum from 3-month to 30-year. And short-term to long-term, and I've looked at the pathway they took during the course of 2024. And it was a split year. During the first half of the year, rates went up across the board. The US T-bill rate stayed pretty constant. Then for the third quarter, rates came down, and then the Fed cut rates in September of 2024, and almost magically rates started going up again. In fact, as you can see, the T-bill rate is the outlier. All of the other rates ended the year higher than they were at the start of the year. The T-bill rate was the exception. It came down during the course of the year, and it continued to decline in that last quarter. So it seems to have a different game that's driving it. We'll come back and talk about it. So that's what Treasury rates did. Now, if short-term rates are coming down and long-term rates are going up, the yield curve is shifting, right? And during the course of 2024, the yield curve shifted fairly dramatically. On December 29th of 2023, the yield curve was distinctly downward sloping. What does that mean? Long-term rates were lower than short-term rates, and it happened across the spectrum. And of course, the doomsayers were out in full force, because for years now, decades now, the conventional wisdom is if the yield curve is downward sloping, then it's bad for the economy. A recession is around. And of course, during the course of the year, there was no recession. And not only that, the yield curve became upward sloping, very mildly so by the end of the year. Am I reading anything to it? I never bought into the notion that a declining yield curve was bad for the economy. And I'm not going to buy into the notion that somehow an upward sloping yield curve is going to make the world a better place or the economy stronger. So I'm going to take it for what it's worth, but the yield curve clearly shifted. So an eventful year for the treasury markets. Now, if treasury rates change, of course, there is a return effect, and especially with a long-term bond like the 10-year bond or the 10-year treasury, there is clearly a price effect that happens when the T-bond rate increases, as it did in 2024. So I decided to compute the return you'd have made on a US 10-year treasury bond in 2024. You bought the bond at the start of the year, your coupon rate would have been 3.88%. You'd have got the entire 3.88%. That's your coupon return. But during the course of the year, that bond went from 3.88 to 4.58%. First, let's get a sense of what's going to happen. When rates go up on a bond, the price is going to drop by how much? It's a very simple calculation. I took the coupons as a given based on a 3.88% coupon rate and computed the present value of those coupons. And I'm doing this on a constant maturity bond, which means the maturity stays at 10 years, just to keep it comparable. The price of that bond would have dropped from 1,000 face value down to 944.8. In other words, you'd have lost 5.52% of the bond price during the course of the year. Minus 5.52% price change, 3.88% coupon, the total return in 2024 for a 10-year T-bond was minus 1.64%. Was not a good year to be a T-bond investor. Now, of course, that's a nominal return. If you take out the inflation in 2024, 2.75%, the minus 1.64% becomes even worse. On a real basis, investing in T-bonds would have delivered a return of minus 4.27%. So that was the T-bond market. Now, of course, when you think about what it is that drives interest rates up and down, over the last two decades, we've been fed this notion that it's whatever the central bank thinks rates should be. Well, I mean, I think that, that's led us down some bad paths, because if you accept that, then the reason rates were low between 2008 and 2021 was because the Fed kept it low. Through what? Through mechanisms under its control, quantitative easing, buying bonds. And along the way, we've lost sight of core fundamentals, the fundamentals that drive interest rates. Now, it is true that central banks have access to data and that they might have the capacity to alter those fundamentals, but ultimately rates are driven by fundamentals. Let me build on that notion. I keep thinking back to my early economics classes where we talked about what it is that drives an interest rate. And ultimately, interest rates have three components to them. There's an expected inflation component, which is when you buy a bond, you're going to set a rate that covers expected inflation. There's a real interest rate component that's to compensate you for giving up current consumption, because if you're buying the bond, you're giving somebody else the money to consume now, but you can't consume for the next period. That's a real interest rate. And there's a default component, which is the person you lend the money to might not pay you back. If you take the default risk out of it, focus on a riskless interest rate, there are only two components. It's an expected inflation component and an expected real interest rate. That's going to be my pathway for thinking about the fundamentals that drive nominal interest rates. I'm going to try to estimate a nominal interest rate each year based on fundamentals. So to begin with, I need an expected inflation number. In my initial calculations, I'm going to take a very simplistic view. I'm going to take the current year's inflation and make that my expected inflation rate for the future. You can obviously use alternatives to this. You can use a 10-year average. You can use an expected inflation rate from forecasters. But let's keep it simple, because I want to do this going all the way back to 1954. So if the inflation rate is 3% this year, I assume that's the expected inflation for the future. For the expected real interest rates, I have to do some gymnastics. For the last 20 years, you've been able to observe a real interest rate through the TIPS bonds, through inflation-protected bonds. But since I'm going back to 1954, I need something more intrinsic. So I'm going to argue, and this is an argument that I think has a reasonable basis, that in the long term, your real interest rate has to be roughly equal to your real growth rate. Why? Because when you promise a real interest rate, your economy needs to grow by at least that amount for you to be able to deliver. So if you have a 2% real growth rate, that's your real interest rate. Here again, I'm going to take a simplistic view of using this year's real GDP growth rate as my proxy for the real interest rate. Up front, I've admitted they're very rough proxies, but let's see how those very rough proxies do in explaining T-bond rates. So in this graph, a graph you've seen before if you've seen my writings, I've computed an intrinsic risk-free rate each year by adding the actual inflation rate that year to the GDP growth that year. And then I'm comparing it. Superimposed on this is the 10-year T-bond rate. Let's take a look at the graph. Do the two move together? Yeah, obviously. But the implication of this graph is, in a sense, much, much bigger, right? Because if you look at why rates were low in the last 10 years, the answer is very simple. It's because inflation was low and real GDP growth was anemic. Low plus low is low. Why did rates spike in 2022? I can tell you elaborate stories about the Fed, but the truth is they spiked because inflation spiked. The intrinsic risk-free rate offers you a very good explanation of why rates move through time. In fact, coming into 2025, the difference between the intrinsic risk-free rate and the actual T-bond rate, which spiked in 2022 and the actual inflation rate went to 7-8%, is the lowest it's been in 4 years. So those are the fundamentals that drive interest rates. Now, of course, you're saying, what about the Fed? I'm not going to be naive enough to say the Fed has no effect. But I want to look at two things. One is the instruments that the Fed has at its disposal to affect interest rates. And second, how much of an effect it is. The primary instrument that the Fed has used all through its life is a rate called the Fed funds rate. What is the Fed funds rate? It's an intra-bank, overnight borrowing rate. So it's not a rate that you or I will ever see, but it's the only rate the Fed directly controls. So in this chart, you see the movements of the Fed funds rate over time. And as you can see, we went through an extended period in the last decade where the Fed funds rate was close to zero. Then in 2022, it spiked as inflation went up. Then and it's essentially stayed high. So that's the Fed funds rate until you get to 2024 and you get the cuts in rates. The question is, who borrows the Fed funds rate? Not very many people. There are some interest rates out in the marketplace that are connected to Fed funds rates, but most corporate borrowing doesn't happen at the Fed funds rate. It might not even be affected directly by the Fed funds rate. So you're saying, why does this matter? Ultimately, if you think about the Fed funds rate, it's because it can transmit to the bond market. It's sending signals. We'll see how strong the signal is. But to see how Fed funds rates move with Treasury rates, I decided to look at the Fed funds rate. That's a column that you see there, the gray column, and superimposed on it the 3-month Treasury and the 10-year T-bond. And you take a look at the 3-month Treasury in particular, you can see that it almost mirrors the Fed funds rate. You're saying there, the Fed sets the 3-month T-bill rate. Not so fast. These are contemporaneous rates, right? There's no indication of one leading the other. So I tried a test. I said, if I can see the change, if the Fed is in fact the leader in this process, here's what I would expect to see. When the Fed funds rate goes up in a month, these are monthly rates, I should expect to see T-bill rates and T-bond rates go up in the next month. That's a Fed effect. So I wanted to see whether that happened with a very simple or maybe even simplistic statistical tool. I looked at the correlation with the change in the Fed funds rate and the change in the 3-month rate and T-bond rate, both contemporaneously and in the next month. So let's start with the contemporaneous correlations, and you see what you saw on the graph. The 3-month rate and the Fed funds rate, if you look at the same month, are incredibly highly correlated, 0.75. Even the T-bond rate is pretty strongly, but that's in the same month. If you look at the Fed funds rate change in a month and the changes in the subsequent month, the T-bill rate still has a ripple effect. There seems to be some spillover effect, and you can tell a story that maybe the Fed actions affect the 3-month T-bill rate. But the T-bond rate correlation drops off to about 0.08. It's statistically significant, but there's an insane amount of noise. So if the Fed raises rates this month, you say, what will that mean for T-bond rates next month? The answer in the data is, I can't tell you much. In fact, I decided to reverse the process. In what sense? I looked at changes in T-bill and T-bond rates and the Fed funds rate in the next month. In other words, I was testing an alternate hypothesis, where instead of the Fed setting rates, the market sets rates and the Fed follows. And you know what? The correlations look just about the same if you reverse the process. The evidence is about as strong that the market interest rates drive the Fed as it is for the Fed setting market interest rates, and both correlations reveal an insane amount of noise. Now, I'm not going to be naive enough to argue that the central banks don't matter. They do. So I started thinking about what it is that drives central banking influence. Why do central banks in some countries affect rates more than others? And there are 3 things I thought of, and maybe you could add to this list. The first is, it is true that central banks have access to information that's preferential, that only they access. It's exclusive. The Fed collects data on the economy and inflation all the time, and it's data that they have that the rest of us don't. So the better that data is, the more you're looking at Fed actions as a signal of what are they seeing in the data. So when you see the Fed raise rates dramatically, it must be because they're either seeing higher inflation or a harder economy than they wanted in the data. So the first is information. The second is the Fed, you're assuming, is independent when it looks at that information. But in much of the world, central banks are not independent. If an election is coming up and the government puts pressure on central banks to keep rates looking low, does the bank kind of bend to those desires? So you're looking to see, is the central bank clear about what it's trying to do and how independent it is? In fact, think about the two most highly regarded central banks of the last century. One is the Bundesbank before the euro, and the Bundesbank was notorious in many ways for its independence, its absolute central mission of keeping inflation low. And it worked, right? The Deutschmark was one of the most highly regarded currencies in the world. The US, the Federal Reserve, in the post-Volcker years, because Paul Volcker essentially broke the back of inflation by saying, we'll take a recession. And he did it in spite of political pressure. And so that's a sign of independence. So the more independent a central bank is, more credible it is, the more its actions affect the market. If the central bank is viewed as an instrument of governments, it very quickly loses credibility. And once it loses credibility, it can do whatever it wants. Raise rates, lower the rate, nobody cares. Third, there is the level of interest rates. Think about the primary mechanism that the Fed has to send a signal to the market. It's the Fed funds rate, right? The way it works is if inflation is higher than expected or the economy is hotter, you raise the Fed funds rate. Conversely, if the economy is weakening and you're facing deflation, you lower the Fed funds rate. You think, so what? As the level of rates decreases, that second action becomes more difficult. It's one thing to be able to raise and lower rates when that's at 5%. The rates at 1%, the room for you to do something on the downside decreases. That's a problem the Japanese central bank has had for much of the last 3 decades, and the US and European central banks also had in the last decade. So when your power is one-sided, your power diminishes. Here's my general proposition, though. I think that central banks are powerful. And I accept that central banks can also buy bonds, they can do all kinds of neat stuff. But the collective power of central banks comes from that credibility, that perception that they have power and that they care ultimately about the fundamentals, inflation and the economy. Now, to the degree that you trust them on those fronts, central banks have power. But if the trust starts to shake because banks don't act in a way that indicate that they have special information. And I think one thing that troubles me about central banks is, I remember when central bankers said very little and you almost never knew who the other people on the FOMC were. You might have, always knew who the Fed chair was, and often and only because they were called in front of Congress, but they said as little as possible. Think of what's changed since 2008. Central banks have become more visible, they've become more aggressive, and they've become more arrogant. I see central bankers on CNBC telling the world what they think about the economy and rates, and I think the more central banks put themselves front and center, the less credibility they have. I'm willing to be proven wrong on this, but I think the Fed has lost power by being more visible and the FOMC being so. The more markets focus on making the FOMC the center of the universe, the less the FOMC is actually going to matter in markets. Prove me wrong, but I think that's the place we're at right now. Now, in terms of whether you should forecast rates, there's a first question of should you forecast. It's unclear to me that experts bring anything to the table in terms of forecasting rates, and their track record is abysmal. I think interest rate forecasters exist to make soothsayers and tarot card readers look good. They're awful in their forecasts. Now, I'll take that to heart. I don't try to forecast rates. If you remember, when I valued the S&P 500 at the start of 2025, the second data update, I assumed that T-bond rates would stay at 4.58%. I can almost guarantee they will change, but I don't know in which direction. So I don't try to forecast rates because I'm not good at it. But maybe you want to forecast rates for whatever reason. You want to normalize them, clean them up. All I would recommend for you is if you make a forecast of a change in interest rates, tie it to a story about changing inflation or real growth, because it will play out in your valuation. Higher interest rates driven by higher inflation will generally have neutral effects on value for companies with pricing power because they'll pass the inflation through. It'll have negative effects on companies that do not. Higher interest rates that are precipitated by higher real growth might have neutral effects in the market, because whatever you give up with a higher rate and a higher required return, you also gain back as higher earnings. The forecasts of interest rates that leave me completely untouched are the forecasts which are almost entirely built around talking about the Fed, what the Fed will do and will not do. And because I'm sorry, but I think interest rate debates have become almost useless in the last 2 decades, because almost all of it revolves around what will the Fed do. I mean, we've lost sight of the big fundamentals. So those are treasury markets. Let's turn to the corporate bond market. It gets a lot less attention than the T-bond market for an obvious reason. It's tied to T-bonds. Last year, when the T-bond rate went from 3.88 to 4.58%, corporate bond rates went up as well. Now, of course, they did not go up by exactly the 0.7%, even with the 10-year corporate bond. And that difference between a corporate bond rate and a T-bond rate, of course, is the default spread. And default spreads do vary across time. So I took a look at default spreads broken down by ratings class. So I'm cheating here and letting, a ratings agency step in, ranging from AAA down to CCC and below. And I looked at what happened to default spreads during the course of 2024. And the story I'm going to tell you is going to be a mildly familiar one, which is default spreads during the year decreased, more so for the highest yield companies, but they decreased across the board. I think of default spreads as the price of risk in the bond market, and during 2024, the price of risk in the bond market decreased. We could go into why, but if you remember, we talked about the price of risk in equity markets a couple of sessions ago. And I talked about how the equity risk premium decreased during 2024. That shouldn't surprise you. Same investors inhabit both markets, and if you think of the price of risk as this battle between greed and fear, in 2024, the greed won out over the fear and risk premiums dropped in both markets. I actually keep tabs on those two numbers, the equity risk premium, which is 4.33% now, and the bond default spread. In this case, I'm going to pick a BAA. That's an investment grade default spread. And I keep tabs on them because the two tend to move together. As you can see in this graph, over time, in most years, they move together. In the years when they don't, there's usually reason to be wary. Those are years before adjustment. For the most part, bond and 2024 both moved down. Did they move down proportionally? That's a question for a different day. But clearly, the price of risk in the bond market went down. Now, when people start to fear less and greed increases, it shows up in another place as well, as in issuances of bonds. In this graph, I actually have bond issuances broken down by investment grade and high yield every year, going back to 2014. Take a look at 2024, and I want you to focus on the percentage of bond issues that were high yield. That number in 2020 and 2021, peak greed years, was high. It was well in excess. It was close to 20% in 2020 and almost 25% in 2021. And then it completely imploded in 2022. Why? Fear went up and high yield issuances dropped close to nothing. Well, we're starting to see a comeback. Maybe not to the greed years, but a comeback of high yield. And in 2024, about a sixth of all bond issuances in dollar terms came from high yield bonds. Now, the other thing to notice about 2024 rates is fewer and fewer companies expect to go back to the good old days when rates were 2%. They're starting to adjust, and it shows up on two metrics that I've tracked. The first, I've looked at the percentage of bonds that are callable bonds. You're saying, why would that be affected by the level of rates? When a company issues a callable bond, it wants the rights to be able to call the bond back and replace it with bonds with lower rates. You know what? When rates are 5 or 6%, you want to issue callable bonds because rates go to 3%. But if rates are already at 2 or 3%, what's the point? And in fact, if you look at the last half of the last decade, 2014 to 19, 2014 through 18, the percentage of bonds that were callable bonds were 60, 70, 75%. Take a look at what's happened to that statistic as rates have risen since 2022. And if you look at 2024, 89% of bonds were callable. What does that mean? Well, companies have accepted that this is not going to go away, and they're going to build in the option into their bond issuances, hoping if it goes down, they can take advantage of it. But you're seeing the percentages creep up. The other metric I've kept track of is the percent of bonds which are floating rate bonds. That number had dropped down to 9% in 2020. Why? Think again of advantage of floating rate bonds. You borrow money and then you preserve the right to kind of reset the rate if it goes down. So floating rate bonds are attractive when rates are high, but if you can borrow money at 2.5%, which is what you could borrow in some parts of 2020, you want to lock that rate in for the long term. So you're starting to see again the floating rate percentage start to go up again as rates are settling into the 4, 5, 6% range. The world is changing and companies are adapting to a new interest rate order. That's healthy, and it's worth noting. So in conclusion, as I said at the start, I'm an equity guy. I mean, I like equity markets. They're fun, they're exciting. I personally don't relate much to bond markets because of the focus on the downside. It's not the place I like to be. I'm not passing judgment on people in the bond markets. It's not where I like to be. But the reality is I need to be, I call it dabbling, familiar enough with what's happening in those markets, because unlike what happens in Vegas, what happens in bond markets seldom stays in bond markets. It spills over into equity markets. Remember 2022? Worst year in bond market history. The return on a 10-year T-bond was minus 20%. Minus 20% on what's supposed to be a safe investment. Did it spill over into stock markets? Absolutely. How can it not? So I'm glad I took a look at interest rates and took a look at what they did in 2024. And I hope you're glad too. And I hope you found the session useful. Thank you very much for listening.